So, welcome back to the continuation of the discussion of forward futures and options, which is the derivative products we are discussing. So, now we will cover and discuss about future contract, how they are traded, the margin accounts and the settlement, how they are done, the hedging using futures and optimum hedge ratios. So, if you consider, we are only considering the futures. Now, if you recall, there was a subtle difference between the forward and futures. In one case, one was basically over the counter, other was not. In other case, the prices of the time to expiration was when it happened, others it could be traded depending on before that, something to do with the American option and the European option. So, we will continue the discussion with the futures, because the futures has a market where they are traded. So, future contracts are available on wide range of underlying assets. Exchange traded instruments are one party agrees to buy an asset at a future time for a certain price, and the other party agrees to sell the asset at the same time for the same price. Specification need to be defined, what can be delivered, what is the quantity, what can be delivered, where it can be delivered, what is the price, what is the quality of the goods, so on and so forth. They are settled on a daily basis. Vast majority of the contracts do not lead to the actual delivery of the product. They are basically traded, that means a position is opened, position is closed depending on the need of the person without the actual delivery, buying and selling of that actual product, whether it is a financial instrument, whether it is a commodity actually taking place. Now, in order to basically mitigate the risk, reduce the risk between a buyer and seller, long and a short position for a futures, you need to have basically a account, because if you remember in the last slide we said that the settlements are done on a daily basis. So, depending on the price or depending on the demand and supply, you have price and quantity, then one of the person, either a buyer or a seller, that is on a long or a short position, would make a profit, another person would make a loss. Now, what is a little bit concerned for the person who is making a profit is that the person who is making loss may default. So, in order to stop that, generally you have the margin account, where the daily price fluctuations are reflected in such a way that in case the person defaults, the overall amount of money which is there in the margin account or some collateral account which is there can compensate the loss which the person who is making a profit can face in case the person who is making a loss defaults. So, basically a margin is cash or marketable securities deposited by investor with his or her broker in order to basically mitigate the risk, and this is a type of collateral. The balance in the margin account is adjusted to reflect the daily prices. How? We will see that. And margins minimize the possibility of a loss through default of a contract which may happen by a particular person. So, margins basically are margin accounts. They would be an initial margin. There would be a concept of marking to market. At the end of the trading day, the margin account is adjusted to reflect the positive and negative price movement in the futures market, such that all profit and losses are taken care in the account accordingly. Maintenance margin is that some percentage of the initial margin which is kept as a buffer, such that in case the overall money in that account follow below the maintenance margin, obviously there is a margin call in order to bring up that money back to the initial margin. And variation margin basically occurs due to the price fluctuation of the futures depending on the demand and supply on a daily basis. So, this is a simple graph which I have drawn in order to make you understand. So, consider the datum black one is the 0 value. So, this is the amount, and the yellow line which you have and the green line which you have is basically, it means this is the maintenance margin. That means, any amount below this yellow line is definitely not needed and not expected also, and the actual height or the value of the green one is the initial margin based on which the overall trading starts. So, this I am drawing as a cumulative margin account also. Obviously, it will depend, the amounts will depend on number of contracts which are being bought and sold, number of items which are there per contract, what is the price. One unit price fluctuation obviously will have an effect on the contract, because a contract need not have only one item, it can be a conglomeration of such 200 different type of items which is being bought and sold. Based on that, your futures or forward contracts is made. Now, consider on a daily basis the time frames are basically on the x axis. So, these are the time frames, I am drawing it for your convenience. So, from the first day the prices goes down from point A to point B. So, obviously the overall amount of the money decreases and the person who is making a profit would obviously compensated by that particular delta amount in the price change, in case the person who is facing a loss, who thinks the prices will continue decreasing, defaults. Day 2 also the price falls from B to C, then also the person who is making a profit would be compensated by this amount. Day 3 consider the price increases, goes to point D, then obviously the flow of money would be in the reverse direction, such that the person who was making a loss till now would gain by the delta amount depending on the price movement. So, this is the delta amount. Now, day 4 consider now the value of the whole contract goes down in such a way that it falls from D to E, which means that E point has a value which is less than the margin account or the margin maintenance margin. Then immediately a call is made. Call means not the call option, a call is made by that person trading house, and the person has to deposit a certain amount of money which is given by this variation margin, such that the overall amount of money goes back to the initial account money which you have. So, it means that in case the person had default and E, then obviously the whole overall amount of money which is there in the account can compensate the loss which may happen for a default. Then again from E to F, which you have moved, is basically a vertical jump because you have deposited money. Then consider from F to G the prices increases for this person, such that the overall amount of money in the maintenance margin has now increased. So, in case I have just given a small example here, that the amount of money which is the vertical drop, the blue one, is withdrawn by the person, or if the money is not withdrawn, if it is kept in the account, then compensating interest rate should definitely be levied. So, in this way the fluctuation occurs, and when the position closes, both the person basically decide what is the amount of money to be exchanged between those two players is exchanged, but the margin account for both the players are kept in such a way that any negative price fluctuation for one is there in order to compensate the loss the person may face in case the person who is the other party defaults. So, consider this simple table which you have exactly as in the graph, but before we solve this problem, note which is given at the below. Total number of contracts is 200, initial margin is 4,000 and maintenance margin is 3,000. So, now the futures price is given in the first column. So, it is changing from 400 to 397, 396.1, 398.20 and so on and so forth. The daily gain and loss are given in the second column. So, in day 0 the price was 400, in day 1 the price has fallen down into 397, which means a fall of 3 rupees. So, now how many contracts you had? You have basically 200 contracts. So, the overall price fluctuation for each contract is minus 3. So, total loss would be 300 into 200 into 3, which is minus 600. I had noted down. Next day the price falls from 397 through 396, which means per contract minus 1, not minus 1, sorry, 397 minus 396.10 is 0.9, 0.9 into 200 is the number of contracts, the overall fluctuation basically is minus 180. The next day prices increases from 396.10 to 398.20. So, now there is an increase is happening of plus 2.10. So, plus 2.10 multiplied by the number of contracts is basically the total profit is happening. So, if you have the daily loss and gains and then try to find out your basically cumulative loss and gains as given, like minus 600, then minus 600, minus 180 is minus 780, then minus 780 plus 420 is minus 360, then minus 360 minus 220 is minus 580, so on and so forth. So, you have basically the cumulative loss and gain. Now, you want to find out how is the fluctuation in the margin account happening. So, if you remember the initial margin was 4,000. So, now it will be initially 0th day was 4,000. Now, cumulative loss is minus 600. So, it falls down from 4,000 to 3,400. Next, it falls down from 3,400 to 3,200. So, if you go in this way, these are all the falls which is happening. But note down one thing, your maintenance margin was 3,000. So, in the moment it basically falls below 3,000, a margin call is given, and the margin call is given in such a way that this 340 will bring that value back to 3000, that is 2660 plus 340 would bring it back to 3000, plus 1000 will basically bring that amount back to the initial margin which you have. So, we have considered that this is the call will happen in this. In the next case, due to increase in the prices which is here 60, the overall value becomes 4060, which is 4060 is greater than 4000. So, in that case the person could have withdrawn that 60 rupees. So, we are mentioning here 60 which is in pink shown could have been withdrawn by that particular person, but we are not basically trying to show it here. So, based on that, with this table and the graph, you can basically draw the margin account and really understand how the overall fluctuation of the prices happens, which basically is reflected in the margin account, such that any person who is making a loss or a profit is compensated in such a way that if the other party defaults, then the margin account of that other party is there to take care of any untoward incident which may happen. So, other definitions are we will consider day trading happens. You will also consider the spread transactions depending on the demand and supply of the prices. You have the sell and buy prices. You will have exchange clearing houses, which are basically a place where the exchanges takes place between all number of players, such that it is basically a marketplace in a very rudimentary sense, where the exchanges takes place between parties, such that the demand and supply basically is reflected in that exchange place. You will have a clearing margin, you will have a normal market where the future prices increases as the time to maturity increases, and you have the inverted market where the future price decreases as time to maturity increases. So, why I would rather going to the actual definition and going into the detail of discussion, I will just give you the flavor of what you mean by that, just a rudimentary example, and I will urge the students to basically study from the book which is John Searle in order to understand the concept in details. There are 2 points for that. Why I am doing that? Point number 1, the amount of coverage is huge. Point number 2 is that if I start going through the details, then obviously we will go very slowly. Then people would not be encouraged, or they would not find it very encouraging to read the book. So, I would strongly urge, strongly request the students whatever to read, to whatever I basically discuss, so that it will give them a much better picture that what I am trying to discuss in the area of options and futures. Now, in the futures market, you have the settlement price. The settlement price is the average of the price at which the contract is traded immediately before the end of the trading for the day. This price is important as it is used for calculating the daily gain and loss. If you remember the margin account, we have basically considered that price. And then open interest is the total number of contracts outstanding. So, depending on the position, if somebody has opened a position and not closed it, or somebody bought and not sold it, or sold and not bought it, depending on whichever situation you consider, the total number of contracts which are still outstanding would be considered as the open interest. And it is either the sum of all the long position or the sum of all the short position cumulatively. So, a person can go into different long positions, different short positions, and finding on the cumulative of them would give you the open interest. Now, why the delivery period, when the delivery period is reached, the futures price is equals or is very close to the spot price. The question is why and how it happens, and if it does not happen, what is the problem. So, why it happens? An arbitrage opportunity will rise if they are different, because if they are different, obviously people will play in one market and buy and sell in the other market. So, if the prices are increasing and I want to basically sell, or prices are decreasing and I want to buy, I would basically play in such a way that my overall profit is positive in the cumulative trading which is being done both in the spot, which is room 1, as well as in the forward of the futures of the option, which is in room 2. Now, how would basically the delivery period, when it is reached, how the future prices, if they are not equal, what happens? If futures price is greater than the spot price, then obviously we will short a futures contract, because spot price at time t0, if it is less than the futures price, then I will sell the product according to the price which is there in the contract, which means I will buy it from the market at a lower price, sell it at a higher price and make a profit. In case if futures price is less than spot price, what I will do? I will buy. Why I will buy is that if the futures price is less, I will buy that contract, and basically sell in the open market in order to make a profit. So, in whichever position we see, either for a futures being greater than spot or the futures price being less than spot, we will basically take the position or of a short futures or a long futures profit in order to make position in order to make profit. So, we will now consider the convergence of spot futures to the spot. Now, if you remember, I discussed that whenever some demand and supply is happening, there is a particular price at a quantity. So, this is the price and the quantity which I have discussed. Now, what you are considering in forward futures and options is something different. The reason being that there are basically two different ways you are trying to handle. So, let me explain it in detail. In room 1, which I have been mentioning, you have the actual spot, the product, the actual thing which you can see. Either it can be corn, it can be log, it can be some gold, silver, copper, anything, maize, wheat, rice, which you are buying and selling and has a spot price. In room 2, you have a particular financial product which is a derivative based on the actual product which you are buying and selling. So, now the derivative, whether it is a forward futures or different type of options, is being dictated in the price on two fronts, main two fronts. One is the demand and supply of that forward futures or options in room 2, and number 1 is basically what is the relationship between the price fluctuation which is happening between the actual product and the derived product. Now, if you have that, once I draw on the time scale, you are basically drawing on the x axis, and on the y axis you are basically denoting is the unit of money, unit whatever is yen, dollars, rupees, dirhams, Canadian dollars, UK pound, that does not matter. So, if you see, this spot is the price in room 1, futures is the price in room 2. So, in case if they do not merge, obviously persons who are there in the market and they are in both the rooms, room 1 and room 2 with their corresponding brokers, will sell and buy, go long and short in any of the rooms, and in order to basically make an extraordinary profit. So, whether the price of the futures is below and is slowly coming to the spot, or whether the price of the futures is above and slowly coming to the spot, basically gives that the demand and supply match happens at the time of expiry, such that nobody makes an extraordinary profit or a loss. Now, when you are hedging or using futures, you will use either a short hedge or a long hedge depending on whether the company will sell an asset or buy an asset at a particular time. So, we are basically going for a short hedge or a long hedge. You think the prices are moving in such a way that by going for a short or for a long, you are able to compensate any negative price movement of that actual product. Actual product means the in room 1. A long futures position is appropriate when you know you will purchase an asset in the future. I want to lock in the profit. So, I want to basically long means I want to sell, and short means I want to basically long means I want to buy, sorry, and short basically means you want to sell. So, when you know you want to basically purchase an asset, and if the prices are on an increasing trend or on a decreasing trend, if you think it is a decreasing trend, you would never go for that forward and futures, because you can buy it from the market at a lower price. But now, considering the prices are increasing on going on an upward trend, so basically you fix on a price, and the moment basically the time to expiration come, you utilize this price to basically buy that product or purchase that product, because if you had not done that and you had gone to the open market, the actual price you would have paid would have been much higher. Consider the short one, I want to sell. So, obviously, if the prices are much higher, it is better for me. Consider the prices are on an increasing trend. So, if I were to sign a short contract, I would definitely not use that, because the prices are always on upward trend. I will sell in the open market and get a higher price. Now, consider the other way, the prices are falling. So, I basically will sign it at the short contract at a certain price. So, whatever the prices prevailing spot is in the market, if it is lower, obviously I will utilize the short position in order to basically sell it at a higher price. So, it can be, say for example, you are an oil rigging company, and you know that you will basically drill oil at a certain point of time and you want to sell it in the market. So, obviously, we will go for certain type of contracts or derived products as that it is agreed up between you as an oil producer and the other person who is a buyer, such that you are able to sell that particular crude at a certain price, such that any negative price fluctuation does not affect you, because you have already gone to a contract. So, if the prices are increasing, you will sell it in the open market. If the prices are decreasing, you will sell at that particular price based on which you have signed the contract. So, arguments in favor of hedging. So, companies should focus mainly on their business and take steps in order to minimize the risk depending on type of contracts they buy. So, their main concern is not the contract, their main concern is the business, and they use the concept of derivative in order to minimize their overall loss. But in general, it is seen that hedging using futures contract is less than perfect due to the following reasons. Asset whose prices is being hedged may not be same as the price of the asset underlying the futures contract. So, this is what I have been trying to imply. In room 1, you have the actual asset or actual financial product which you will buy and sell, and its counterpart, the derived product, would be in room 2. So, if I consider the price movement between room 1 and room 2, the actual product and the futures of the forward product, if they do not match, obviously there is mismatch. So, that would basically have a different effect in the price movement, such that your overall methodology of trying to basically minimize your loss or risk may not be exactly true. Futures contracts is closed before the expiration date. So, this is what, if you remember, I have mentioned that the forward futures are for a duration of 3 months. So, in case if you need that actual product after, say for example, 3 months, exactly 3 months, so there is a mismatch of time does not occur to that maximum extent. But consider 2 case scenarios. Scenario 1, you need the actual product 4 months down the line, and scenario 2, consider you need it 6 months down the line. So, in the first case, when it is 4 months, it means you will definitely match the 3 month with the derivative, but the 1 month which you have, you are not able to match. Hence, there would be a huge amount of fluctuation may happen, such that the overall quantum of risk may be high. Second case is that for a 6 months, what you will technically do is that roll over the 3 months for 2 time periods. First 3 month contract expires, second 3 month. So, as you are doing that, the price fluctuations start increasing. So, you will see later on that the concept of volatility or the change of the dispersion or the variance is such that it is time dependent. So, the more you go down the line, hence the volatility will start increasing in such a way that it will have an adverse effect in the overall risk motivation based on which you are trying to basically minimize your risk. Uncertainty about the exact date when the asset will be bought and sold is also not known, as I mentioned in the example where it is 4 months and 3 months. Hence, you will see for all these different cases, there is some mismatch which you have to basically understand, and based on that you will try to formulate your simple problems in order to minimize your overall risk. Now, we will consider that all this risk basically leads to the fact of the basis risk. So, basis is the difference between the spot and the futures, which is S and capital F, which is the spot price of an asset to be hedged minus the future price of the contract which is being used for hedging. So, again room 1 you have the spot which is S, room 2 you have the futures of the forward which is F. Now, basis risk is basically a difference in these prices. Basis risk arises because of the uncertainty about the basis when the hedge is to be closed. As I mentioned, when you need the spot, you do not know. The actual duration of the spot, even if it is known, may not match the exact forward and futures duration, because the durations are different in both the cases. So, we will consider 2 important aspects of the basis. One is the increase in the spot price when the increase happens is more than the future price, and weakening happens. In the first case, it was strengthening. In the second case, it is the weakening of the basis which is increase in the futures price is more than the spot price. So, if you go back to the slides, what we have understood later, first one was basically, in this case the futures was above, in this case the futures is low. So, depending on which direction the futures prices are moving, the price fluctuation would be such that the basis risk would basically have this component of increase or decrease, and you have to basically make a distinction how you will try to mitigate the loss, whether you are on a short or a long position. So, with this small note, I will close this lecture today, and next day we will start off considering the concept of basis and how the basis risk can be considered and how the rollover basis can be considered, as a very typical example and how what are the values we should basically consider and along with the variables of importance. Thank you.